I want to continue on this bond theme. As you know, we've been talking about the Federal Reserve is going to end their bond purchase program, according to Janet Yellen, in October of this year, and then looking at raising interest rates in 2015. So one of the things, quote, that she said was, when interest rates begin to rise, if firms or individuals have taken risks and aren't adequately prepared to deal with them, they can cause distress. Well, I think she's being very kind in using the word distress, because you can have, for every 1% increase in interest rates, depending upon where you're at on the spectrum of interest rates, whether you hold 10-year, 20-year bonds or 7-year bonds, and most of you out there don't know because you own bond funds, and we're going to continue on that talk, is that you can lose anywhere between 7 to 16% per 1% rise in interest rates. So let me give you an example. So right now, the 10-year bonds are trading around 2.5%. Okay. Really, in a normalized economy right now, we should be probably around 4%. So let's just say it's a 1.5% increase. On a 10-year bond, that's going to rise 1.5%. You would lose about 10%. Okay. If you owned a 20-year bond, you would lose about 25% on just a little 1.5% increase in interest rates, which can happen very quickly. So, if, to make that real simple, if you own a portfolio of $100,000 worth of bonds and you own long-term bonds and you have a 1.5% rise in interest rates, you would lose $25,000 in principal. So you have less money. You lost money. It's no different than the stock market. So I hope that's clear. And, the more and more, I see clients and we talk about bonds, the more and more I realize that you have, some challenges with it. And it's not your fault. It's not necessarily complicated, but it's just something that you've not been used to because you've always been told that bonds are very safe and secure and don't worry about them. Well, Warren Buffett says bonds should come with a warning label right now. And I totally agree. So if you have bonds in your portfolio, and I'm going to give you an example of a client to really that strikes home on, how real, the misunderstanding or lack of knowledge in this arena. And I am here to help and protect and educate you. So pay attention to this. I had a client this last couple of weeks ago that came in, but he was a prospective client at the time. And we were going through his portfolio and he had, over $500,000 in bonds in a bond fund. And what he didn't realize was that as interest rates rise, which I explained to him, as rates rise, so let's say you own a 3% bond and bonds rise to 5%. Well, do I want your 3% bond? No, I want the 5% bond. I get paid a higher dividend, higher interest. So what happens to that bond portfolio that you have today? It gets what's called discounted or goes down in value because your 3% bond, if I'm going to buy it, I'm going to buy it at a cheaper price. So I explained this to him and he got that. And then he said, well, David, I'm getting like 3.5% rate of return on my bond as the yield that I get. And he said, so, I don't really care if my bond portfolio goes down because, I will still get my 3.5%. And I said, well, sir, if your portfolio is worth 20% less, you're going to receive 20% less income and you're going to have a 20% loss in your portfolio. And it really took a while for him to get this. And this is not uncommon though. I'm not picking on this gentleman. This is normal. He had a different perspective on it and I had to take him down this path. So again, as interest rates rise, the value of your bond portfolio or bond fund will go down. It's just a matter of how much. So there's a lot of new risk in your portfolios you have right now because interest rate risk was not as big 5 years ago, 10 years ago, because the rates had been falling and they've been falling for 30 years. We've not been down at these levels since 1950. And from 1950 to 1980, the inflation adjusted returns of bonds were down 40%. Okay. We're in a very similar situation. So I don't want to see you hurt by that. So the question is, what do you do? Well, there's a couple things. Number one, we want to reduce the duration or length of the bond. So getting as short as possible, under 5 years for sure. Another thing to do would be to buy individual bonds, which you're going to be paid if the bond, you don't have credit risk and there's no bankruptcy like a municipality or something like that. You can own individual bonds. are a safer bet relative to interest rate risk, not necessarily credit risk. But a real simple solution is, and I talk about it, is buying a fixed annuity, buying an annuity. You lose the interest rate risk problem. You have principal protection. You generally have guaranteed payment streams, and that will allow you, which is based upon the claims paying ability of the insurance company. Typically, they're in the 5 to 6% range on a distribution on an income basis. And, that can help to offset the risk of the stock holdings that you have, because you have this protected capital on one side of the ledger, so to speak. So let's say it's 50% stock, 50% bond portfolio. Replace the bonds with an annuity or some of the other strategies I talked about, and you just reduce the risk of the portfolio, because you now have more risk right now, to me, with stock market at all-time highs and, valuations in certain sectors stretched. And, it's not a time to be super aggressive. And, our clients are retirees or going to retire, and we want to make sure that we focus on income, and rate of return is secondary. What I tell clients all the time, I don't care if it's a stock, a bond, a mutual fund, an annuity, it doesn't matter. I'm a fiduciary. We have clients that own all those assets. But the point is that all I care about is, are we going to have lifetime income? Are we going to have the lifestyle that we need? And is it going to continue for the rest of our life without running out of money for both you and your spouse? So if you want to talk with me personally and do what's called a second opinion, where I'll review your portfolio and give you a complimentary, comprehensive second opinion on your taxes, your investments, your retirement, Social Security, estate plan, give me a call. It's 877-406-CALL, 877-406-2255. That's 877-406-2255. This is David Reyes on AM 760, your retirement architect, and we will be back soon.
A well-designed, tax-free retirement. And you can have it.
How come I didn't find out about this before?
The retirement architect, David Reyes, will continue next.
How would you like to pay zero taxes on your retirement income? You heard it right, zero taxes. Most Americans are sitting on a time bomb and won't even realize it until it's too late. Up to 85% is taxable due to poor IRA distribution planning. Would you like to know how to reduce or eliminate those taxes? Our advanced planning can show you how to turn your retirement account and your Social Security money into a lifetime of tax-free income. Call Reyes Financial Architecture now at 877-406-CALL. That's 877-406-2255. Our 7 secrets to a stress-free retirement kit might be your first step to a tax-free future. Just imagine that. No taxes on your retirement income and no required minimum distribution. It's time to take control of your retirement by removing the shackles of government that tell you how much to withdraw and how much you can keep of your hard-earned money. This service is absolutely free. Call Reyes Financial Architecture now at 877-406-CALL. That's 877-406-2255.
Did you know there are 567 ways to claim your Social Security? Mistakes could cost you up to $250,000 in lifetime benefits. Take charge now. Get yourself educated. Reyes Financial Architecture is your San Diego expert in maximizing Social Security and retirement income. Sign up now for our next workshop, Smarter Social Security and Income Planning. Call now, 1-877-406-2255.
Imagine working your entire life and losing half or even more than half of your retirement to market risk and taxes. Many of you don't have to imagine because this is reality for you. What if you could eliminate market risk and convert your retirement to a tax-free income? Guess what? You can. Our complimentary second opinion review will show you how it's possible. Then you can decide if a tax-free retirement income works for you. Call Reyes Financial Architecture now at 877-406-CALL to see how being tax-free from market risk and having a tax-free retirement income could be the key to your financial future. Again, call Reyes Financial Architecture at 877-406-2255 today and ask about the 7 secrets to a stress-free retirement kit. Information is power. Do you think the market is going up or down? Let me ask you, is that the right question to ask? Here's a better question. When the market goes up, do you get to lock in your gains? What if you had a plan in place and didn't have to stress about the market going up or down? Here's another question. Do you have a plan to never outlive your retirement money? What if the market crashes at the same time you need to start using your money for retirement? Taking withdrawals from your retirement account can have devastating consequences. Our 7 secrets to a stress-free retirement kit can show you how to avoid market risk and how to create a predictable income stream that can rise with inflation. Pick up the phone and call Reyes Financial Architecture now at 877-406-CALL. That's 877-406-2255.